Something that makes One Rental at a Time very, very different is the fact that we interact with experts across the landscape of investing. And we have the one and only Mr. Jonathan Twomley on today. How you doing, Jonathan?
I'm good, and I'm happy to be back. It's been a couple weeks since I was on the show for various reasons, so happy to be back. I always miss it when I can't be on.
Yeah, and the audience missed you. A couple of people asked, and I said, "Hey, just schedules didn't work out. Where he's going to come back, I promise you." So I'm glad you're back. And again, you bring a different slant to the channel. You obviously have an area of expertise, which is not mine, kind of the larger multifamily space, and that's what I want to hone in on today because I think there's a lot of. I don't think people really realize how bad it might get for some real estate oriented billionaires. I've often made fun of Barry Sternlicht. I call him Billionaire Barry, who's gone on CNBC with PowerPoint, just whining and crying and begging for the Fed to pivot or cut. But I also think there are some well-known multifamily syndicators who have celebrated buying deals at 3.5 caps, and now, at least recently, have been calling themselves billionaires, which may be true at the moment. I want to pull up an Excel spreadsheet. I'm going to have you guide me through doing some very rough massaging of data showing that they're a billionaire, and then talk about what happens if it's not the favored nation it once was, and we go from 3.5 caps to 5 or 5.5. When does a billionaire frankly go broke, or at least go negative net worth? Because I think it's a lot sooner than people realize. Does this make sense?
Yeah, sure.
All right, well, let me bring it up. I'm actually not sure how this will go, but we will give it a shot.
All right, let's do our best.
Let's see what we can do. So again,
I'm glad it's you with the Excel and not me. Let's just put it that
way. So I have literally pulled up just a blank spreadsheet. So again, what I thought we would do is, again, we're going to make very, very broad assumptions. Let's assume they bought, I don't know, 10 billion in property, because I think that's where we have to start. Would that be fair?
10 billion.
Well, if they're a billionaire, right, and you're going to have, or maybe 5 billion.
Well, I guess, okay, let's just sort of figure out, I guess, to make it simple, that they bought it all themselves, right? They're not sharing it with investors. They didn't syndicate, right? So,
we're going to assume that in this wild example, yes.
And let's just assume that there's, they finance 75% of that, right? So it's
exactly.
Yeah.
All right, so that's $10 billion.
Yeah.
We're going to say we're going to do an LTV of 75%, just so people realize the math going here.
Yeah.
All right, so that's going to be that's going to be a loan of 7512123 Okay, and then just do very simple math, and here. Right. So again, this is this is the net worth, right?
Yeah.
We can change these numbers if we wanted later. What are some other things we might do that, like if you were going to look at this again, very high numbers.
Yeah.
If this was, could you look at that $10 billion purchase? No, it's done at 3.5 and back out the NOI. Would you just divide?
Well, yeah. Well, so the thing is, you would have to decide what the cap rate is, right?
Yeah, 3.5. That's what we're going to do.
Okay.
Billionaire says.
So basically, what you would do for this is you would. See, if you divide the NOI by so you have to multiply multiply that by 3.5%. Let's say I gotta do this backwards, because I'm so used to going the other direction, right? So rather than trying to derive NOI, this is like the one thing I never do, is try to derive NOI from the.
Yeah, sorry.
Using
this is not normal. I totally appreciate it. We're just trying to slam this together.
Hold on. Let me get out my calculator, and I got to think about this. So if we had, let's just say we had a million of NOI divided by 3.5, it's 28 million. So that means that, so to go from 28 million times 0.3.5. Yeah. So basically you have to multiply. So you multiply the 10 billion by 3.5%. Right. So you're going to get a lot. You're going to get, but that's going to be a lot smaller number. It's not going to be 350 million. It's going to be much, much smaller. So you got 10 billion.
10 billion?
Yeah. 10 billion.
Yeah, that'd be 350 million. Because if it was 10%, it would be 1 billion.
Oh, you're right. Yes, you're right. Okay. That's a lot of NOI. Okay, well, we're talking about $10 billion worth of real estate. Okay, so yeah, that's right. All right, I got confused by all the numbers. I'm not used to seeing. I mean, you always talk about me being the big investor, but I don't see numbers like this. So
let's actually get this close, because again, we're talking about somebody being a billionaire, and right here they're worth 2.5 billion. So
yeah,
let's
so
see if
we could cut this in half. Yeah,
Let's do that.
Okay.
Not too many zeros.
Yeah.
Need another 3 zeros. No, yeah. Do I?
Yeah.
No. 500.
People are looking at
these are big numbers, man.
Yeah. What are these guys doing?
Zeros.
Yeah, 500 million. There we go. Okay, and then that's going to be so 75% of that.
Then okay, so now they're worth $500 million. So okay, so then
no, you got
so they're not quite billionaires here. Remember, that's what we're going for.
Yeah, but so your LTV is wrong because you still have 75 million there. It should be 75% of 500 million.
Oh, equals. Okay.
Yeah.
There you go. Times 0.75. Thank you.
Yeah, and actually you need another zero in your 5 because it should be 5 billion. You've got 500 million. So there we go. Okay. That's okay. Now it works.
Now it's
okay.
Close enough.
Yeah, close enough. Okay.
Okay.
So yeah. So this is
what we know. Yeah.
Yeah. So let's just say, I mean, it gets very simple, right? Because I would actually have to set this up a little bit differently, but you're going to, so the calculation here is you've got your 3.5% cap rate, right? Going into, so it's going backwards right now because you've derived the price. So when you change that number, it's not going to change things the right way.
No, but we're gonna build it down here because I know because right now, just to check the math, right? We would normally take this divided by this, and it would equal. See, it equals 5 million, right? So now what we're gonna do is we're gonna do just that. We're gonna take this number equals this divided by this. Why is that not working?
Yeah, you made it circular.
Oh,
because it was already deriving off of that before. So you got to just data entry the 175 million just backwards.
Let's do this again. See, this is why we're doing this line. We'll just do it manually.
Otherwise, I think you should title this episode "How to Embarrass Yourself Live with Excel."
Yeah, that's okay. I'm not embarrassed. I'm just trying to show people how quick this money can go away.
Yeah.
Can I do this?
No, oh yeah. You're going to get the same problem. Let me tell you what to do. Just instead take the cell with 175 million in it and just just enter that in as data. Just enter it in as text.
I did. This one?
Oh, no, the C10, go to C10.
Oh, C10 is the problem.
Yeah, and just enter the number in, and then use the formula in B9 to get B9. Okay. To get the value. There you go. Yeah.
Okay.
Because now what we can do, so now I would just copy this whole formula again down below, just the whole thing. Yeah, so we can have it to compare. Okay. Now just take that 3.5 and just change it to 4 and see what happens.
Oh.
See, just by going up by 50 basis points on the cap rate, they've lost 200 million or 160 million of value. Then we can just go up, right? 4.5. Now they're not a billionaire anymore, just because cap rates have gone up by 1%. So it happens really fast, right? That you're going to lose.
I want to know when they're broke. I want to know when they're broke.
Yeah, well, we don't have debt in here, so we don't, because we're just taking the LTV. The thing is, the other thing is, what we have to do. Here's an error we made. Okay. So the LTV is not going to go down, right? So
that's true. Yeah.
So that shouldn't be a formula. That should just be just entered as text below there. Yeah. So, then
this should be 375. You're right. That's the problem.
Yeah.
Because the debt doesn't change.
Yep.
Now we're going to get somewhere. That's the missing piece.
Yeah.
Look how quickly this person becomes broke. That's exactly what I was going for, because the debt doesn't go down. I knew
Yep.
this would be so again, they're a billionaire and they celebrate being a billionaire and buying things at 3.5 cap and overpaying. And they were on the balance sheet. And now cap rates go from 3.5 because the debt doesn't change. If you just get to 5, they're broke, at least on the balance sheet. And that's without NOI going down. And we know that taxes are up, insurance up, and rents down. And again, we've assumed nothing else than a cap rate change. They're broke at 5% caps.
Yeah. I mean, and if you think about it, right, the reason that they're broke so fast, like if you move if you start out with your property and everything's valued at an 8 cap, right, and you go up to an 8.5 cap, well, the percentage change is much less than when you go from 3.5 to 4, right? Exactly. So the 3.5%, well, that's great. You're getting, if you do a value add and you add a tiny amount of money to your NOI, right? You've just added a huge amount of, value, right? But but if the cap rate changes, well, all that value goes away. And so if you're starting out at high cap rates and they go a little bit higher, well, you're still okay. But so this is why the effect is like multiplied when you're starting out with such low cap rates, because it doesn't take much of a move to really
the cap rate went up roughly 50%.
Yeah.
And you're broke.
Yeah.
And that's not unreasonable, right? 3.5 caps were stretched. They were artificially compressed because the interest, risk-free rate of return was 0. And if you celebrate buying it at 3.5 cap, it's not uncommon to see these go to 4.5 or 5. That's not a wild, doomer scenario. It's very likely. Historically, these assets traded at 5. Now we have a risk-free rate of return of 5. So having these go to 5 is probably conservative. I just wanted people to realize that we have billionaires, perhaps like Billionaire Barry and other well-known, folks in this space who are not billionaires today. If they did an honest assessment of their net worth, they're not billionaires. They have maybe been audited billionaires a year ago. They are not billionaires today, given this very simple equation.
And if you want to see why, like some of these, like in San Francisco, those guys just handed the keys to those hotels back, right?
Yeah, 3,000 units, the largest hotel in San Francisco, $750 million loan. They said, "Oh, here's the keys." Jingle mail.
And you can, if you think about, well, their NOI has dropped from what to what, right? On those assets, you can just tell so you can see just like on an asset basis how the asset has become worthless to them, right? And so they just hand back the keys.
Do you want to see how bad this is, Jonathan? I mean, let's just assume their NOI went down 30%.
Yep.
Let's just assume that, because this I think is going to get bad, and I think this will work. So let's, instead of 137, so let's just take 60 million off. So it's a little more than 30%. So that's now 115. Oh my gosh.
Yeah, I mean they're way underwater, right?
Yeah, remember Donald Trump talking about years ago where he walked by a homeless person and said that person's worth more than me. We have former billionaires in this space who bought at ridiculously low cap rates that now are negative $1 billion.
Yeah,
that's wild.
Yeah. Well, let's just go back up to the second example, right? Let's just reduce the second, the one above that. Okay. Yeah, just go into the NOI number, the 175 million, and I just want people to show like what a difference this makes, right? Actually, you know what? Copy it next to it rather than reduce that. Copy the whole, whole thing. Yeah, and let's just put it side by side, and so people can see. So just so just reduce that even at the same cap rate to 150 million. And see how quickly this changes if they just lose some NOI at such a low cap rate. I mean, it's $200 million right there. You've lost. You did not reduce your
taxes up, insurance up, everything,
whatever,
up,
or revenue,
occupancy down.
Yeah. So you could be in a market right now like Texas, right, or Florida, where especially Texas, right now, Texas, and this is like I always, for years, I've always warned people, like, be cautious about the markets that are hot where everybody is going, because it will not last like this forever. Right. And it's great when you
Agreed.
get in early, but like, you have to be looking for the under the radar places. What's happening in Texas right now? Everybody's darling for such a long time because of the population growth. But the population growth hasn't slowed down. But what has happened? Well, insurance has gone through the roof, and property taxes people are getting whacked so hard with property tax, because the way they work in Texas is just a simple application of like 3% to the value. It's like 3% of the value, right? And when you've got values that have just jumped so enormously, it's whacked your NOI. So the cap rates, even if the cap rates haven't changed that much, you could be in some of these markets and have your NOI get whacked by insurance you never expected to see and tax rates you never expected to see. And suddenly, your NOI, you could be looking at, losing these assets because your NOI has dropped because of these expenses, right? And even if rents are still going up in some places, and Texas, some of the markets in Texas are where they're actually having rent decreases because they've had so much supply, right, come on the market. They're I mean, it's no surprise that the big foreclosures that we've heard about are in Texas, right?
Yeah.
They haven't been for multifamily, right? I haven't seen any. I mean, San Francisco obviously getting whacked on some of these commercial properties, but you're not hearing like,
no, not yet,
big foreclosures in California, because the rent, there's such constrained supply that the rents are not falling, right? But in places where it's easy to build, well, this is what happens. You get overbuilt, and when you got the expenses at the same time, I mean, it's just, it's crazy.
I want to highlight the green cells because I just took your example. Because again, my whole talk track here is how quickly can $1 billion vanish? So all we did is we lowered the NOI $25 million.
Yeah.
And we raised the cap rate 0.5%. You are now have a net worth is zero.
Right. Because your worth is the same as your debt. Right. So
this is how quick, this is why I strongly believe there are many real estate billionaires that are no longer billionaires, and many of them are negative.
Yeah.
And this is going to be a problem. And
listen, everybody who's in office right now is in this situation, unless they bought these assets a long time ago and didn't refinance, right? If they were very conservative, didn't take money out, right? So, but if they refinanced to take money out, which probably a large portion
that was what you did in the game, right? That's how you borrowed money, debt's not taxable, all that stuff. So again, the whole point of this video is there are people celebrated on social media today calling themselves billionaires, and if they did an honest introspection of their balance sheet, they're just not. I mean, the cap rate went up 0.5%, so 4% is below the risk-free rate. Not possible. NOI down, I don't know, what was that, 12%? Not unreasonable. There are a lot of former billionaires out there in this game. So, Jonathan, we're going to get into some more meaty topics. Thank you for letting me embarrass myself with my poor Excel skills. I knew you could help me do it. Jonathan, if somebody wanted to follow you, how could they do that?
Yeah, absolutely. Well, come to apartmentinvestorsclub.com. You can get a free download from me called How You Do Your First 100 Unit Plus Deal with Other People's Money and Get Paid to Do It. You can download that. You can also come to Apartment Investors Club on Facebook. And I never talk about it, but I have a podcast called Apartment Investors Club, as you might imagine. We've finally gotten smart and linked it to this show. So, and I started actually using all the videos that I've recorded for the podcast and uploading them to YouTube as well. So come and check it out. I interview really great people in the multifamily space, real experts, and they've got a lot of interesting things to say. So come and check it out.
Awesome, buddy. Thank you so much.